Okay, part two, as we continue on investing in bonds. As I mentioned, bonds are often preferred by investors when the stock market is a little bit shaky or rattled, such as what we have today. Bond, a little bit like stocks, the way that you can make money in bonds is that they can appreciate in value and they do pay interest. Actually, they have to pay interest, whereas stocks pay dividends, as we mentioned, if they make a profit, and if the board of director, so declare that there will be a dividend. Now, if you hold the bond for the full time to the maturity value, 10, 15, 20 years, you get that maturity value. If you cash it in early, and sometimes people do, uh, you get a lesser amount. It's a little bit almost like when you have a certificate of deposit in the bank, that if you pull the certificate early, you get a guaranteed higher interest rate because you're leaving it in for a certain time period. If you take it out early, there's a penalty for an early withdrawal. That is, in essence, what works for bonds. So generally, if you're going to buy a bond as an individual, your best intent should be to leave it in for the time of the bond, 5, 10 years, whatever it may be. But that is basically, how a bond works. Now, there's different types of bonds. Basically, there's two, and one is a corporate bond. And we talk a little bit about that. They're issued by generally large corporations, very safe investments for the most part. These are your Disneys, General Electrics, Walmarts, Discover, companies like that. Basically, blue chip companies that you don't have to worry too much about. Again, since there's not a lot of potential return, there's not going to be too much risk, and that is fine. The other type bonds that are issued are known as governmental bonds. We've talked about U.S. savings bonds. They're obviously issued by the United States government, the federal government. There is no risk in these, so hence the return is very small. The nice thing with U.S. savings bonds, you can buy them for small amounts, $25, $50. Often they're a good gift for a child or maybe even a grandchild. But bonds can be a good gift like that. Now, there are other governmental bonds, and we have to remember that there are risks in these type of bonds. Sometimes we think that anytime a governmental entity issues a bond, there's not going to be any risk. Well, that's not the way life is. U.S. savings bonds are backed by the full faith of the United States government. But when you buy a bond in a city, a state, a county, something like that, there is risk. Usually not a lot, but there can be. There have been several public entities in the last 25, 30 years that have gone under. None of you would remember this, but I think it was in the mid or late 1970s, so quite a while ago. New York City filed bankruptcy. They could not, they were having some financial problems. They could not pay their bondholders, pay the interest, or repay the bonds. And as I said, anytime a company holding bonds, whether it's a corporation or a governmental entity, cannot make their payments, they automatically go into receivership or bankruptcy. Orange County in the late 1980s, early 1990s. We think of Orange County as a very vibrant place, maybe not today with the coronavirus, but with Disneyland, Knott's Berry Farm, all there is to do, the beaches, everything there is to do down in Orange County, California. How could they have financial problems? But they filed bankruptcy. Theirs was more a problem of some corruption, some dishonest employees who did not invest the sinking fund. Remember, the sinking fund is the money that is invested, pay the bondholders, and they kept some of the money. So a very unfortunate thing, but Orange County had to file bankruptcy. Now, Orange County is still around, so is New York City. It's a reorganization bankruptcy, but those who are holding the bonds didn't get repaid, didn't get their interest. Birmingham, Alabama, a few years ago comes to mind. I think Stockton, California, one of the kind of Central Valley of California, one of the cities there, went bankrupt. So sometimes governmental entities can go under. When a governmental entity issues a bond, generally they're doing it to build schools, an elementary, junior high school, or a high school. I was out going toward Tooele a few weeks ago, and I'm not sure when the election is or if it's this fall. Because of the growth in Tooele, they need some new schools. And so they have a bond issue, and the voters will decide, those who live in Tooele County, whether they want to issue the bonds and use that way of going in debt to build some new schools that are needed for the increasing population. So that's generally what governmental bonds are used for: highways, schools, things of that particular nature. Again, there is risk in bonds on these public entity bonds, and so before you buy those, you need to do some checking, just like you would on any investment, and make sure that the public entity is doing good. We'll talk in a minute some of the rating agencies of bonds. On 538 are T-bills, or treasury bills that we've talked about. Treasury bills have no risk. They're backed again by the United States government, just like U.S. savings bonds are, as well as banking accounts insured by the NCUA or the FDIC. T-bills are sold in increments of $100 bills, usually a minimum of $100. They're fairly short term, 4, 8, 13, 26, and 52 weeks. Sometimes they're a good short-term investment, especially if you don't think the stock market is going to do that good. Sometimes people like to put their monies in T-bills. Obviously, the return is going to be small on a T-bill. Again, our lesson learned, and this will be a good potential test question in about a month when we get to that point, and that is the relationship between risk and return. And if an investment has no risk or little risk, and T-bills, as we said, have no risk, obviously the return is minimal. But that's something to actually take a look and consider. On the next page, I got a little ahead of myself, but we talked about on 540 municipal general obligation bonds and revenue bonds. These are done by corporate entities. Again, let's just realize that they are not foolproof, that there is risk, even though it's issued by a governmental entity. We think, well, if the government, the state of Utah, county of Tooele, county of Salt Lake, issues a bond, there's no risk. Well, there is risk. A municipal bond is just one issued by the state or local government, generally to, as I said, improve or build highways, schools, things like that. A general obligation bond is backed by the full taxing power of the government that issued it. So that's the exception. You don't see a lot of those. A general obligation bond would be that if they couldn't pay the bond, then the taxpayers would have to bail out the county. Generally not as many of those. Obviously in New York City, Orange County, the other entities that I mentioned, those would not have been general obligation bonds because those entities had to file bankruptcy. A revenue bond is repaid from the income generated by the project. The two examples I can think of that, sometimes you'll hear about a bond to build a highway, and it'll be a toll road. And the toll road will raise money, and that money is to pay off the bond. The other type, every now and then you'll see where a public entity will build a stadium, an arena that will attract people in, obviously to watch sporting events, concerts, and other things like that. And part of that money goes to pay off those particular bonds, but those are revenue bonds. So you got municipal general obligation and revenue bonds. So make sure you know the difference between those three. And more than likely you'll see a question like that when we have examination number 2. When we choose to buy bonds, if that's the way we go, or if via mutual funds we decide to get into a bond fund per se, the thing that we look at, a little bit like any other investment, we want to look at the yield. And the yield will be the price that the bond goes along with the interest that it's paying. Again, we talked about trend analysis, especially in stocks and mutual funds. And generally, we like to look and see what a particular bond fund has done for the last 5 years, just like as we track any other stock. The decision to buy or sell bonds, it just depends a little bit what the market does. It depends what your advisors may say. I have a couple bond funds. I'm not real excited about bonds. Bonds are a little bit more conservative. But bonds can be very good. They're a good long-term investment, especially if it's held by a good corporation. Now, when you're looking at bonds, it's a little bit, we talked a little bit, if you'll recall, because this could be a test question too, giving you some good sneak previews on the second exam in about a month. You remember going back to insurance. When we talked about insurance companies, they are rated by a company called AM Best and Company. It's capital A, capital M, and then Best, just like the word, and Company out of New Jersey. They rate insurance companies. As we said, you'd never want to insure with a company, whether it's home, auto, business, or life, that was rated less than A minus. Now, on bonds, there are two companies that rate bonds. One is known as Standard & Poor's, and the other is Moody's. And if you're going to buy an individual bond or even a bond fund, you can take a look at the ratings. And if you look on 546, you can basically see the ratings of bonds, AAA on down to C and D. Now, bonding is a little bit different than insurance companies. Obviously, an insurance company is going to pay us if we have some type of fortuitous loss, and we want to make sure that we're insured with a good, solid company. On bonds, though, there are risky bonds. In fact, anything below an A bond would be considered a speculative or a junk bond. But that doesn't necessarily mean we'd never invest in them. Again, I'm not against risky investments as long as we realize what they are, we feel comfortable with them, and they form a small part of our overall portfolio. But basically, any bond rated less than A minus, that would be B plus and lower, would be considered a junk bond. And the term, is what it is. Maybe it's a little too strong. It sounds like something that you'd never want to invest in. That's not necessarily the case. You certainly wouldn't want to insure with a company rated less than A minus. But from time to time, you might, especially through a mutual fund, buy some bonds that are lower rated if you feel comfortable and your advisor feels good about it. And again, it's a smaller part of your portfolio. Again, greater risk, greater potential return. They go hand in hand. One thing, if you're taking a look at bonds that you want to look at, is the yield. If you look at the middle of 547, you can see a yield. The current yield, this is for Boeing, is the annual income divided by, and that's earnings per share, and that is divided by the current market value of the bond. In this case, you can see the yield is 2.94%, and that's not the best yields. That's not the most attractive of bonds. I mean, today it looks great during the coronavirus, but what we've seen the last several years in the stock market, probably not the most attractive. One thing though with bonds is you got to look at, besides just the current yield, is what we call the yield to maturity. Again, there's no mathematical questions on this, but if you look over on page 548, you can see the yield to maturity, which they project out over the time element or the life of the bond. In this case, is 3.4%. Again, not the most impressive, but Boeing is a good, solid company, although they've had some severe problems in the last 8 or 9 months, not just the coronavirus with hardly anybody flying on airplanes, but some of the problems with that one plane, I forgot the name of it or the model of it, that had the two crashes over in Southeast Asia. So bonds are something to take a look at. Again, a couple elements as we finish this one up that I want to talk about. Again, is the importance of diversification. As you go into and start an investment program, diversification just means investing in a lot of different stocks, a lot of different programs, so that when one has some problems, it won't sink you. A good example now are some industries that are just right now flat on their back. We think of the hospitality industry, especially restaurants, bars, things like that. We think of some big national restaurants. You think of Cheesecake Factory, I read, where they are not able to pay their rent. And then, of course, the airlines, which have had to go to the federal government to get a bailout or get some help from this coronavirus package that was passed by Congress the other day. I think all of us have, excuse me, probably seen the picture of that lady, I think, flying from Washington, D.C. to Boston on an American Airlines jet. I believe she was the only passenger on it. So obviously the airlines are hurting too. Who would have thought that 8-9 months ago when our economy was booming? This is why we've got to diversify. There are so many uncontrollable factors. Excuse me again, uncontrollable factors in the world and in the economy. And that's why we've got to diversify and be in it for the long haul. If we do that, we'll be able to ride these out. But if we put all our eggs in one basket, if we have too much confidence in one segment of the market, we could be in trouble. So next week, we're going to talk more in particular about mutual funds. As I said, to kind of wrap this up, a couple items. Number one, I'm going to send all of you an email later today and just give you kind of some bullet points of where we're at, where we're going, maybe a general reminder if you haven't turned in the 5-point assignments. Now, again, the 5-point assignments is number one, why wouldn't you invest, from 2 weeks ago. Last week, what is one investment goal? And number three, I gave you number three, and that is tell me how your budget's going. And I'm going to give you a second one right now for today. So today you'll be turning in, or this week when you hear this on YouTube, you'll email me too. Number one is going to be how you're doing on your budget. And number two, I want you to just tell me why, in your words, it's so important to diversify when you start to invest. I've talked about it so much, but I just want to make sure everybody has a sound understanding on this, because it's such an important element and principle if you're going to really get in and invest. Diversification reduces risk. So your 2 5-point assignments for today that I'll look for in emails, texts, or however you want to get the information to me, and just put it in one email. And you'll notice if I do it correct in Canvas, you'll get 5 points for kind of an update on your budget assignment, and another 5 points on this, and that is diversification. Why is diversification so important? Just explain it in your own words, and I want to make sure everybody has a feel for it. We'll kind of review that again next week, because we're going to get more specifically into mutual funds. I'm going to get you a couple prospectuses out, try to do that this week, so you'll kind of see the wonderful diversification that is built into a mutual fund. So keep working on your budget. I'm a little concerned because I don't get to visit with you one-on-one or have the one-on-one contact that we have in class. And that's for your book report and your term paper. Today's, as I record this, is Monday, April the 6th. So we've only got about a month, and it's going to be a busy month. Working at home has its own challenges. As you know, a lot of you have small kids. You've got to take some time to get the book report and the term paper done. Again, I'm not looking for a dissertation. I'm looking for 4 or 5 pages just as a summary on the book that you've chosen and the topic that you've chosen. I have a couple ask about the 3 articles also. Some of you have not turned that in. the 3 articles. You just to go online. If you go into, MSN or CNN or wherever you go into, there's a section always on money. I just want you to write down. You can either give me the link or you can just tell me that these were the 3 articles that you looked at regarding personal finance. If you can't find anything per se, just Google personal finance. Obviously, you'll get more than you'll ever need. Susie Orman, please look at that. Take some time, maybe do it with your family. You should have a lot of time at home now. I know we're looking at more movies and things on YouTube than we ever have at our house. I think you'll really enjoy that. And of course, I hope that once a week, whatever your chosen date is, Monday, Tuesday, Wednesday, Thursday, Friday, whatever it is that you're going in and tracking your 10 stocks and seeing how they're doing. There should be some real fluctuations in that. And then, of course, at the end of the month, after 5 weeks, in essence, you'll take that final price, multiply it by the number of shares, and in essence, you'll sell it. And a 5-week window is short. You may or may not make some money, but it'll be interesting to see how your 10 stocks do. I hope everyone's doing good. I enjoy doing these, even on YouTube, not nearly as much as I do in person when I can have more interaction. I would just tell you again, and I'll put this in the email that I send you later. You know what my phone number is, 801-910-8499. I'd love to hear from you. Text, email, or if you want to give me a telephone call if you have any questions. I've heard from a number of you, and I've always enjoyed the visits. I hope that everyone is doing well. I wish you nothing but the best, and we'll continue from here. My best to all of you. Thank you.